sales to check if promoters lowered their tax by inflating cost before public listings. Ola Electric lays off 1,400 to 1,500 employees as its expansion hasn't led to enough sales. Piyush Goyal heads to Washington, D.C. to meet U.S. trade officials. Meet set to be focused on reciprocal tariffs. India is likely to skip retaliatory action during talks. May also discuss cutting duties on product lines. The adjusted HSBC India manufacturing PMI slows to its weakest since December 2023. February's manufacturing PMI stood at 56.3, down from 57.7 in January. Supreme Court takes suo motu on regulating online content as centre to come up with draft guidelines subject to the petitioner furnishing an undertaking that whether Ranveer's show will maintain the standards of decency and morality. The petitioner is permitted to resume the Ranveer show. Low-budget comedy Anora has triumphed at this year's Academy Awards, winning 5 Oscars. Another notable mention was No Other Land, a film made by an Israel-Palestine collective about displacement in the West Bank, which won Best Documentary Feature despite no official distribution in the US. Hello and welcome. This is Profit 360 on NDTV Profit and I'm your host Himakshi Bahogana. Along the next half an hour, we'll bring you the latest on the markets as well as national and international news. So viewers, the Income Tax Department is probing questionable transactions where promoters, their associates and anchor investors purchased unlisted shares of companies and later sold them through an offer for sale when the companies went public. Over the past 10 days, the department's investigation wing has issued multiple notices questioning investors across various cities about their methods for calculating the cost of acquiring the unlisted shares and the subsequent profits made during the OFS. My colleague Shrimi Chaudhary is joining us with exclusive details. So Shrimi, can you explain exactly what violations the IT department is looking into?
First and foremost is, of course, Income Tax Department is scrutinizing the promoters and anchor investors who, exited its holding just ahead of public listing through OFS. Income Tax Department is trying to gauge whether the capital gains tax were paid on the subsequent sale or not. Income Tax Department sources tells NDTV Profit that about 216 such OFS transactions happened between FY21 and FY24 is now under examination. Income Tax Department is looking into all those transactions, and the move triggered after these promoters and anchor investors has filed the revised tax returns and not sort of showing, and rather there is a discrepancies and misreporting as far as capital gains taxes are concerned. In fact, the Income Tax Department also somewhere suspect that there is an intent of artificially inflating the cost of acquisition to sort of reduce their tax liability. Meanwhile, CBDT, asked all the field formation across the country to have a special drive on the matter, since there are a lot of companies and it's coming from most cities, and that's why they decided to sort of go ahead with a special drive invoking the Section 55 pertaining to the cost of acquisition on the share sale and on the profit which typically promoters and anchor investor make. Taking cues from that, they're also sourcing data from NSE and BSE, and they have done their own data analytics, and basis of that they are now started sending notices to all these promoters and anchor investors seeking explanation over misreporting of capital gains in their revised return, and somewhere also trying to gauge why there is a confusion on the cost of acquisition. NDTV Profit has reviewed the February 3rd letter of CBDT asking field formation to sort of initiate action and priority give priority to these, OFS happened between these 4 years, and also somewhere sort of directing tax sleuths to, take action accordingly. And they have in possession of the name of the companies, the name of the OFS and the shareholders and their promoters, and based on that they are, trying to sort of match their revised income tax return, and you will see a lot of such notices will be issued to them in the coming, weeks.
Right, Shrimi, stay with us. I'd also like to know that is this routine or did a tip-off prompt this probe?
Yeah, as I mentioned, the move triggered following the discrepancy seen in the revised tax filing by these promoters and anchor investor, where they have found some, issues with the cost of acquisition, the way they have been calculated and the way they have not sort of paid capital gains tax as anticipated. And somewhere, the move also triggered from the fact that in the July budget 2024, there was a clarification with respect to the cost of acquisition and how it should be computed. That was not reflecting there, and the seller, in these transactions during the OFS, it was sort of noted that seller anticipated that it is a tax exempt on such transaction, and somewhere there was also confusion with respect to fair market value. So basis of that, the move triggered, and at the same time CBDT also got information across the country that these things happening, capital gains tax were not paid appropriately as per the transaction. So that's why the special drive is now being rolled out, and accordingly the income tax department is supposed to take action, and we will see a lot of such notices going to promoters and anchor investors. And remember, these are a lot of such marquee companies. OFS also happened between these 4 fiscal years, and we would see related action in the upcoming week itself.
Thanks, Shrimi, for bringing us those exclusive details there. Now on to an NDTV Profit exclusive. Ola Electric has initiated a second round of layoffs in less than 6 months. This is likely to affect nearly 1,500 employees. Notably, half of these layoffs involve contractual workers. My colleague Tushar is joining us with more details on this. Tushar, can you please provide more details on this development and why this company is under scrutiny?
Good evening, Himakshi. So the Ola Electric story today is in 3 parts. The first part is the layoffs. This is the second round of layoffs in less than 6 months. About 1,400 to 1,500 employees have been affected. About half of these are contractual workers who are hired to man the experience centers that the company had opened in December last year to fix the sales and service related issues that the company was facing in the prior months. Now these have been let go because the sales are not matching up. So this is an added cost for the company at this point of time. Sources tell us that several of these new experience centers are not even recording 1 scooter sold every month. Remember, all of this is being done to shore up profitability of the company, at least on an operational level. In Q3, the company's EBITDA loss ballooned to about 564 crores from about 350 crores in Q2. That was due to this expansion. The aim was to shore up sales. That has not happened. The company is still selling about 25,000 scooters. Founder billionaire Bhavish Agrawal had said that they need to sell consistently 50,000 scooters every month to achieve operational profitability or break even. The second part of the story is based on the Roadster X motorcycle that the company had launched last month, just before its earnings, third quarter earnings on 5th February. The Roadster X is still not roadworthy. Essentially, it has not undergone the process of homologation, which makes it fit for usage on the road. Now, that is important to note because the company was supposed to launch or start deliveries by mid-March. Now, that timeline is unlikely to be met. Third part, we spoke with sources and some investors who indicated that they're sitting on about 50 to 55% loss as far as the investment into the company is concerned. Remember, Ola Electric listed on the stock exchange at 71 rupees, and it's trading at about 54, 55. So there is there's a substantial erosion in valuation of the company. The investor is now contemplating when or whether to exit the company. So a whole bunch of problems for Ola Electric at this point of time. What will be the way out? Only time will tell.
Absolutely, Tushar. Only time will tell what the future holds for Ola Electric. Now, looking at how the markets fare today, all the topsy-turvy trades culminated in a fairly flat end for Nifty and Sensex. In terms of sectors, media and oil and gas dragged the benchmarks lower with cuts of 1%, give or take. Realty and metal, however, did help in reversing some losses with gains of more than 1%. Anushi is joining us with a roundup of all the action on the D Street today.
Right, Himakshi. So if we see what has happened, it's almost a flat ending that we've seen for where the benchmark indices are concerned, and this is with a negative bias. And again, after 8 sessions of decline that we are looking at, as you've mentioned, that the Nifty Realty and the Nifty Metals are the top gainers in the sector today. In fact, what has happened is Nifty Realty has snapped its 5-day losing streak as well. In terms of where benchmark indices are concerned, BEL and Grasim were the top gainers in Nifty 50 for the day, while in top laggards, we had names like Coal India and Reliance emerging up again. Now, the highlight of the day, or rather the move for the day, was the recovery which we saw in the Nifty, in the broader markets as well. In fact, we see Nifty Midcap 150 ending in green, snapping its 5 sessions of losses that we have been seeing. Nifty Small Cap 250, however, there was a strong set of recovery. In fact, it gained about 2.5% from the day's low at close. It still ended with a tinge of red that we are seeing. Some of the stock-specific action, if you want to point that out, in the mid-cap stocks, we have names like Tube Investments, Cummins India and Supreme Industries seeing the largest market cap change in the day, and this is on the positive side we are looking at. And in small caps, if we see, I'm pointing out the green ones, the names which have ended higher, as we have seen a significant recovery at the end of the day. So we have something like Autumn Investment and Infra, 2008-32 crore of a change in market cap, along with names like Narayana, Hridayalaya and Medanta, which were in the picture as well. So overall, if we take the markets, there was some signs of recovery in the later part of the day, which because of which Nifty 50 ended in flat, while mid cap 150 ended in green and small cap 250. However, there was a strong recovery. It was still in red.
Right, Anushi. Thanks for that market check. Now, a market driven by liquidity can also experience downturns because of IT. There are very few buyers and most sellers. Some are unable to exit because they lack liquidity to do so. This is what Samit Vartak of Sage One Investments had to say about the current market outlook.
In this kind of a market, which is more driven by liquidity, when it comes down, again, it's because of the liquidity, right? That some people are forced to exit, some just take allocation decisions at these kind of times. And it's an extremely consensus call these days that you allocate to large caps if you want to be in India and get out of mid and small cap kind of space. So when liquidity comes out, good, bad doesn't matter. Everything falls. It's just a matter of liquidity. And there's so much money which had gone into this space that when things come out, in this kind of times, when there are so many, alarming calls, who is going to be buying at this point? So there are very few buyers, a lot of sellers. Some are not getting out because they probably don't have liquidity to get out, right? So I think these are the times when you get this opportunity. And so I look at it as a cyclical, it's like almost like an annual sale. Or sometimes there is one big sale which happens every 3 years or 2.5, 4 years. That's a very, very common timeline. I don't know what will happen in the next 3 months or 4 months, but I'm pretty sure if you are a good stock picker from a 3-year perspective, there is exciting opportunities, and it will be shocking to me if you can't make money over a 3 to 4 year period, reasonably above average kind of returns from the kind of valuations which are available in some of the select good quality companies.
The adjusted HSBC India manufacturing PMI stood at 56.3 in February, down from 57.7 in January. Pallavi is here in the studios joining us. Pallavi, please take it away and break down these numbers for us.
Right. So, like you mentioned, manufacturing PMI did see some loss in momentum in the month of February, and it actually fell to its lowest since December 2023. So that's a 14-month low. It came in at 56.3 in February from 57.7 in January. Now, to be sure, it remains in expansion mode. A print above 50 indicates expansion. Business conditions were decent across the three monitored subsectors: consumer, intermediate and investment goods. Wherever there was an increase noted, manufacturers said it was largely on the back of sustained improvements in demand, tech investments and the commissioning of new projects. New export orders also saw a rise, as did employment. Input costs did see a rise with a rise in prices of leather, marketing, rubber, telecom. Still, the overall rate of inflation was lower than what it has been the past couple of months. On future prospects as well, firms continue to express optimism for the coming year, with client demand expected to remain positive and supportive of output.
Thanks, Pallavi, for breaking down those numbers for us. Now, India's oldest stock exchange is likely to experience a decrease in trading activity due to the securities market regulator's latest change in the derivative segment. Market regulator SEBI has suggested a new method called a future equivalent for calculating open interest in equity derivatives. This change actually aims to show more accurate price sensitivity and prevent stocks from being manipulated and entering a ban period. My colleague Anushi is joining us to tell us how will it impact the BSE trading volumes. Anushi, over to you.
Right, so we have a couple of brokerages. We've seen strong moves in trade today, not just on BS, even Angel One, and all of these stocks are down. I'll highlight what Goldman Sachs had to say on this note. They've maintained a neutral reading and they've cut the target price to 4,880 now as compared to 5,650, saying that lowering industry option penetration is something that they are seeing, and SEBI consultation paper is to reduce the undue volatility in the equity markets which are there. Now, this move doesn't bode well with something like a BSE, which is there, as option trading accounts for around 1/3 of the, in fact, around half of the top line of BSE. BSE shares are largely pricing in the risk to these industry volumes which are present, and pricing in risk from the implementation of the proposed volume. So while the final outcome still remains uncertain, as this paper was not expected by the market, they have now reduced the target price to 4,880 versus 5,650, which was there earlier.
Right, Anushi. Thanks for that. Now, Union Commerce and Industry Minister Piyush Goyal is traveling to Washington, D.C. to meet the newly inducted Trump administration. This visit comes amid discussions for a year-end trade deal and an approaching tariff rollout deadline during his visit from March 4th to 6th. So, Piyush Goyal is expected to hold talks with U.S. Trade Representative and U.S. Commerce Secretary. My colleague Rishabh has more details.
What we see coming in from the trade talks between the India and the US, a very crucial move coming in from India. Union Commerce and Industry Minister Piyush Goyal is set to visit Washington. In fact, he is on a visit there. Currently, he will be meeting key trade officials from the US, including the US Trade Representative Jamieson Greer, as well as Commerce Secretary of State of the US, Howard Lutnick. Both these meetings will take place between March 4th and 6th, and talks will revolve around, of course, the tariff concerns that are coming in from the USA. The US is set to impose tariffs, the details of which will be made available starting April. And Goyal's visit is remarkable because he is going right before that deadline. The talks will obviously also talk about the bilateral trade agreement, the BTA, which is sort of being looked at as a mini trade deal between India and the US. These two will be just sort of the defining points of this visit by Goyal. What will also happen, and what we're also likely to see, is that India will skip the retaliatory action. So not a very aggressive stance. It will be not looking at a tit for tat sort of situation, but we will be looking at actually just reducing the number of tariff lines that we have on certain exports that both the US as well as cutting duties on a number of product lines, so a zero for zero strategy, if you will, and also invite the US to cut down tariffs and that is basically what an FTA is. It reduces the sort of trade barriers, both tariff and non-tariff between two countries. So this is what we're expecting from CIMs, the Commerce and Industry Ministers, visit to the US. We will stay tuned to his visit and keep track of all the details coming in.
Right, Rishabh. Thanks for that. Now, as Indian tariffs are set to be implemented on April 2nd and tariffs on Mexico, Canada and China are set to be implemented tomorrow, U.S. Commerce Secretary says that he expects the United States to impose tariffs on Canada and Mexico, but the situation is fluid and President Donald Trump will determine the levels. Trump's proposed tariffs from February include a 25% duty on all imports from Mexico and Canada, a 10% tariff on energy products, and a new 10% tariff on Chinese goods. Tariffs on Canada and Mexico were delayed for a month, but Trump has enacted a new 10% across-the-board tariff on the Chinese products. Now, in a major relief for beer biceps Ranveer Alabadia, the Supreme Court has allowed him to continue making content, but on a condition of strictly not using any abusive and obscene words. The court emphasizes that fundamental rights aren't given freely and also stressed that comedy should be enjoyable for all. Responding to the aftermath of the viral incident at India's Got Latent, the court seeks a regulatory system without censorship and has expanded the scope of the case. I'm now being joined by my colleague Nupur from NDTV to brief us on the latest update.
Well, yes, today the Supreme Court, in a major relief to the YouTuber Ranveer Alabadia, has lifted this restriction that it had earlier imposed on him that he cannot appear in any show. The Supreme Court granted this relief after Alabadia prayed to the court that he has more than 280 employees for whom salaries he has to pay, and he requested that it is a matter of his livelihood and prayed to the top court that at least this restriction should be removed. So keeping all this in mind and taking an undertaking from Ranveer Alabadia that he will not further engage in any obscene commentary that he has done, and he will maintain the standards of morality in his shows. He has been allowed to further continue with his own personal podcast and appear in shows. However, the Supreme Court today has also asked the center to, in fact, come up with draft guidelines when it comes to regulating online content, and has said that there is a need to balance fundamental right to freedom and speech with against the morality of the society. And the Supreme Court, today also came down heavily on YouTuber Samay Raina without naming him. Justice Suryakant, in fact, today remarked that he has gone to Canada and made certain comments about the proceedings, and probably he's not aware about the powers of the court and jurisdictions of the court. And today Supreme Court, really stood by its earlier stance that there has to be limits on the, obscenity in the content, and there has to be, some morality that has to be maintained. While even if it is comedy, it cannot be perverted as it was in India's Got Latent show. So, saying all this, the Supreme Court has asked the center to come up with draft guidelines after consulting all the relevant stakeholders. But the Supreme Court has also said that it does not want to do any censorship, but it wants to make sure that the morality of the society is not compromised and fundamental rights are balanced in that way.
Right, Nupur. Thanks for getting us those details there from the courtroom. Now, working on capturing value segment with its A-series, Samsung recently launched 3 new Galaxy A-series phones. My colleague Rishabh Bhatnagar spoke to Aditya Babbar, VP MX Business at Samsung India during the launch. Listen in.
It's a fact that tier 2 below is growing faster in the market today, especially the rural is growing the fastest. So there's a lot of new initiative, what have been brought out there is why we feel that it is very, very important to make the device democratized. It's also equally on terms of experience. So what you see today, the experience in front of the tier 2, tier 3 is, back to the number one out there, the best experience of the device. So we have put a lot of devices on demo there. Third, it is also a very important factor of affordability. So all the 12x0 or the new NBFC schemes are making it affordable for people and very easy for them to upgrade.
Aditya, also talk to us now about what sort of market share growth that is Samsung looking at right now? There are a couple of other brands that are doing better in terms of market share. What's your plan to sort of recoup that?
Well, I think 2024 was a great year of learning, and we have really reset ourselves into three basic pillars of our growth. One is diversification. So we are bringing a lot of 5G under 10,000. Again, at the core of what we have brought is the Samsung philosophy of no compromise. So we have not compromised with the number of bands which are out there. It comes with 12 bands. It comes with a 25 charge, so you don't have a less charge holder. What we are trying to do at a value segment between 20 to 50, where A26, 36, 56 is getting launched today, is bringing a great combination of design and awesome intelligence. And at the value end of the market, we continue to grow the Galaxy AI with the S25 and S24 series.
Aditya, lastly, talk to us about the sort of overall smartphone market, right? 2024 was flattish. Will 2025 be the same?
Well, if I see our last 3-year trends, the market has been very, very flat. It hovers between 145, 147 million around that trend. So it's a very nominal growth. Most of the analysts puts even 2025 as a very flattish growth. The way the year has started, it is looking like it will be a very, very flattish growth. But what's very encouraging is even last year, the value market grew at upward of 20%. So it's a healthy double digit. And what's very exciting for Samsung is that we grew in value faster than the market. So that's a trend we really want to capitalize on and focus on for the year of 2025. And that's where you see the A series getting launched. So I want to talk a bit about A series. That this series have 89 million happy consumers. So there's great news for you today. The A26, 36, 56 is coming, and our target is that how do we do 100 million this year and have one of the strongest franchise out there in the market.
Viewers, that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking care of your altruistic needs. That will be the true definition of Viksit Bharat.
In my view, we are already out of that slowdown.
For every anlom, you have to have vilom. You can't just keep doing up and up in the breathing also. You have to come down. So the correction and healthy correction is a very, very integral part of the market.
The private capital expenditure, from where I sit, I see that private capital expenditure is happening.
Any tariff coming on Indian goods will be passed on to American consumers and Indian companies will not be affected.
We feel fairly good about the fact that we can compete with various folks.
Actually, instead of Viksit Bharat, we should call it Re-Viksit Bharat.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Very warm welcome to you all for this NDTV Profit Conclave, which is themed on Viksit Bharat.
A life which is both taking care of your material needs and taking
Thanks for tuning in to Talking Point Unfiltered. The idea of this podcast series is to try and get into the minds of our guests and understand how do they think about the current situation, be it business, be it markets, and what are the ramifications over the medium term and not necessarily what will happen tomorrow. Our guest today is Samit Vartak of Sage One. Samit, great having you. Thanks for taking the time out.
Absolutely my pleasure. So I think this is the first podcast I'm doing, so I'm looking forward to it.
Yeah, likewise, Samit. I mean, it's been the first time that we are talking on such a format as well, so really looking forward. So, Samit, there is no better time to talk about the market sentiment than when the market is at its worst, right? Because it probably gives you the best opportunities as well.
Yeah.
How do you see this current market environment? Because the unanimous calls that I get range from how it is prudent to not be invested in India currently. Yeah. If you want to be invested, then look at only the large caps. Don't look at the mid caps and the small caps, and keep a certain percentage of your portfolio in cash. There is almost nobody saying that start hunting actively in the mid cap and the small cap space, or that take an oversized bet out there in that bucket. How do you think about the situation?
Yeah, I mean, it's always good to have too many worries around you. That's where you find value, right? So I think after a long time, at least you're finding exciting opportunities. It's not the universe which has become cheap, but surely, if you're a stock picker, you don't need the universe to be cheap. At least there are so many companies in this kind of a market, which are trading at like 15, 20 times kind of a multiple, which were not available. I mean, what happens is that in this kind of a market, which is more driven by liquidity, when it comes down, again, it's because of the liquidity, right? That some people are forced to exit, some just take allocation decisions at these kind of times. And it's an extremely consensus call these days that you allocate to large caps if you want to be in India and get out of mid and small cap kind of space. So when liquidity comes out, good, bad, doesn't matter. Everything falls. It's just a matter of liquidity. And there's so much money which had gone into this space that when things come out, in this kind of times, when there are so many alarming calls, who is going to be buying at this point? So there are very few buyers, a lot of sellers. Some are not getting out because they probably don't have liquidity to get out, right? So I think these are the times when you get this opportunity. And so I look at it as a cyclical, it's like almost like an annual sale. Or sometimes there is one big sale which happens every 3 years or 2.5, 4 years. That's a very, very common timeline when there is a big sale which
is
happens.
That sale, you think?
I think so. This is definitely, last correction we had started in December 21 and it continued sort of towards 22, probably half of the year. And then 3 years down the line, again, September 24 is when we had the peak in the market. So we're already there, 5-6 months. And generally, I've seen that the average duration of correction is that 6 to 9 months. Right? And the faster it corrects, the shorter is the duration.
Right.
So this time, I think the speed was pretty slow, but then last 1 month, the speed has just accelerated. Right? So there has been a sharp correction which has happened. And again, I think we need to remind ourselves that you will never get such a big sale unless there are warning signs around you. So I feel happy if there are too many people warning against it. That means that the weak hands can't withstand such warnings. Only the strong hands will withstand these kind of bombardment of warnings, not just from Indian investors, but also what's happening geopolitically. So I don't know what will happen in the next 3 months or 4 months, but I'm pretty sure if you are a good stock picker from a 3-year perspective, there is exciting opportunities, and it will be shocking to me if you can't make money over a 3 to 4 year period, reasonably above average kind of returns from the kind of valuations which are available in some of the select good quality companies. Right? And again, I think, I put up one analysis on Twitter which is comparing large cap, mid caps, and small caps, right? And I'm comparing more of large cap and small caps, where I divided the universe into 3 buckets. One is PSU companies, right? Then the private banks, because PSU companies and private banks trade at very different multiples, right? And then you have the rest of the universe, right? Large caps, when they say, large caps are trading at 19 times forward or, 21, 22 times kind of backward looking, is mainly because of the mix of the large caps. 1/3 of the profits in large caps come in from the PSU basket, which trades at 8, 10 times kind of a multiple, right? And then when you look at the private banks, which make up for about 17% more, so 50% total, again, they also trade at that 15, 17 kind of multiple. And then you have rest of the bucket, which is trading today at 40 plus multiple.
Interesting.
These are median valuations of, so then you compare that with the small caps, right? There is very little PSU as well as private bank contribution from these. The both put together probably will be 15%, right? So then you look at the mix, right? And then you have the 85% bucket, which is trading at 30, 32 times kind of multiple compared to 40 plus in the large cap. That's the real comparison. You can't just compare a mix of bucket, which has all quality, but if the low quality is high in a certain bucket, overall you will feel that the valuations are low, but that's not really. I mean, how many portfolios have 33% allocation to PSUs?
So effectively you're saying that if you don't want to buy PSUs and if you don't want to buy private sector banks, then the large caps is probably more expensive than the median small cap.
Absolutely. Just look at all the companies. Just remove those 2 buckets, which are always cheap. You can't look at them from a P multiple, because for a 10 times P multiple in a PSU can be also expensive.
Right.
When they trade on an average 5 to 6 times multiple.
Now, for a lot of people who may ask listeners and viewers that there should be actionable points in a conversation, I think the last answer gone by is truly the most actionable point. You don't need anything else. You get some of the key points, screen for yourself, do a little bit of research, and you will get the answers yourself. You actually won't need to watch the rest of the show also if you want. But I think, Samit, thank you so much. That was very well explained. Now, I want to get to the mental aspect of it before I also nail it down to whether you find a confluence of all of these factors in the markets currently and what are those pockets maybe. But just one mental aspect that I want to get out here. You would be owning some small caps which would have seen a drawdown in this last 2-3 months, right? Some maybe 20%, some maybe 30, some maybe 50, what have you, right? How do you decide where is it that you get out of? And how do you decide, can I let me stay put? Because when it falls 30, 40, 50%, you are scared obviously about whether the story is gone wrong or is it just a valuation correction or everything is going down. So how do you decide?
Yeah, so I think one of the big mental reset that one needs to do at this point in time is detach yourself from the existing portfolio. Think as if I am restarting, building a portfolio. I have new money, I need to build up a portfolio now. And see what kind of decisions will you take then, right? Unfortunately, what happens is that because of the baggage of, you having taken maybe wrong decisions or just because of market, fall, things have corrected, you get clouded by a lot of those confusing facts, right? So once you remove that, build your completely new portfolio and then see, is it the same as what you have now? If there's a big difference, just change that. Just make that transition, because after all, your returns going forward will be based on today's valuation, based on today's optimal portfolio. And you need to build the optimal portfolio now without the baggage of having your old portfolio.
But it's an easier said than done thing. Are you able to do it?
I mean, it's just that you need, see, sometimes fund managers do have restrictions of getting out. Sometimes you just can't get out, right? Because by getting out, you probably will have 10% more fall or 15% more fall in the stock, right? So that becomes a hurdle. But for most of the investors, that's not a hurdle at all, right? So it's much easier for, a retail investor to do this adjustment, right? But at any point in time, even as a fund manager, I need to think, my portfolio is what it is, right? There will be some companies which maybe were highly valued. I may not be comfortable. I really love the businesses, but I don't like the valuation. A lot of those companies actually have come back to a very comfortable valuation. So you may have cash or may not have cash. The cash decisions would be very different. You may go for attractive, but I think you need to think about the same thing even here, that you think that whatever you have in your portfolio is an opportunity cost for you, right? You can easily replace that with something that you like, So if something else which is outside of your portfolio is much more attractive, you replace it. This is a time to swap. First of all, if you're in loss, this is a time where you can book losses, save paying taxes, and at the same time get something which is really attractive. So if you're aware of this fact, at least you will consider these factors for decision making, and it would help, because most investors would have lost value in their portfolio. They may not have cash, right? And it's easier for people who were lucky enough to keep cash. But don't bog yourself down with that. Whatever is in your hand, make the best optimal portfolio out of it, and then you'll be shocked. This can continue for sometimes 8 months, 9 months, sometimes a year, 2 years. But when things rebound, you will make up for not only the lost, portfolio value, but even make up really good returns in a matter of 4 or 5 months. It has happened multiple times. I mean, during 2009 fall, small caps had fallen by 70%. And in the next 14 months, the markets were up, the small cap was up 3.5x. That means they recovered entire fall. I mean, such a massive fall. This time it's, the fall is like 1/3 of that.
Yeah, exactly.
Right, 1/3. So it doesn't take much time to recover. But more importantly, make sure that the companies you have are the ones which will recover, because there will be many companies, in your portfolio, which may be a lot of story stocks, which would be much more cyclical, where there was a story, and many of the time in the long run do not do well. But, like I had made a presentation of how cyclical companies, in post-COVID, in the next 4 years, on an average, have gone up 10x, whereas good quality companies have gone up less than 2x during those 4 years. There is a huge gap. Now, if you expect that these cyclical companies will continue to, if they have fallen by 50%, they'll quickly recover, that's like living in a fool's paradise.
So you believe that change will happen now? That
change will happen. But make sure that the portfolio that you have now is made out of companies which are longer term structural stories, where valuation has become really attractive. Forget about the fall in your existing stocks. Some of them will never recover. The breadth of this rise was so large that many of those stocks, I would say, sometimes 70-80% of the stocks will never see the recent highs in many years to come. But if you are just looking for 15-20 stocks, make sure that whatever stocks you have in your portfolio, have that high probability that they will, in 5 years, they'll be much higher than the peak that you saw in the recent past.
And the simplest yardstick is possibility of higher sales growth, right? Because that was one of the key things.
Possibly higher sales growth, as well as possibility of sustainable ROE.
Both.
Because cyclical companies will not have sustainable ROEs. And they will have, generally cyclical ROE.
So you would have played cyclical companies from 21 to 24 if you had played, but you are also out of them. You are now going for the sustainable ROE businesses.
Yeah, I mean, see, one-off you can take a tactical opportunity, but majority of your portfolio, generally should not be. It's a high risk, high reward kind of a game. What we look for is high risk adjusted returns. That's more important.
Got it. So where do you find these pockets now, Samit? And by cyclicals, correct me if I'm wrong, but you are therefore effectively ruling out commodity plays or what else gets ruled out? Let's first eliminate that, according to you.
Yeah, see, highly cyclical companies. For example, what I mean by cyclical companies is let's take, for an example, railways companies. I had put up some analysis, a year back, on these some of the PSU companies, railways companies, how they had gone up, and their valuation multiples had multiplied 5x, 10x. Valuation multiples, not stocks. Valuation multiples, right? So these are the companies where what they sell, their replacement cycle is really long. Sometimes 25, 30 years, right? So you will have great growth for 3 years, 4 years, because government is aggressively going for capex. Right? So then you will have a huge order book which build up. But who knows? Government can completely swap. They will completely reverse their decision of spending on a railway kind of a play and focus on something else, like suddenly. And then suddenly you will see that the order book has vanished, or it just staying flat, or going down slowly. And then no one wants to pay any valuation to these companies.
But so you are, sorry, just to interrupt here, but in a lot of these companies, the order books are still high. You believe the fortunes ahead will not be a factor of order book execution, but order continuation of order wins.
Exactly. There also has to be growth in order book, right?
Growth in order book also.
What P multiple, see, a lot of these highly cyclical companies generally trade at single digit multiples in the long run. PSUs also trade at single digit multiple because of that uncertainty. Generally they only have one customer. Railways also many times have one customer, and then the product replacement cycle is very long. That makes it more riskier. Plus they have huge fixed cost. So if you, during a bull market, go for too much of an expansion, raise too much of QIP money, when the things slow down, at that time your utilization goes down, fixed costs remain, and your margin just collapse. At that time, people go back, with low margin and low multiple. So the double whammy is huge, right? If your multiples from single digits had gone to as high as 40 times or 50 times, right? Add that to at the highest order book or the highest margins, that's one of the most riskiest things that you invest in. Because there is a risk to the valuation multiple as well as to the P multiple and as well as the growth. So that's what one needs to be careful. Are your companies, were they the ones where the valuation multiple went up too much? I'm pretty sure they will revert back towards the mean. Are their valuation really away from their long-term mean? Are their margins towards the higher end? Are those based on really, huge order books, but is their product replacement cycle really long?
Got it.
If it's short, doesn't matter. Then you can, those are much more resilient businesses. And whether your cost structure and expansion was too high, and are you ready for the slowdown? If the slowdown comes in and you're sitting on a huge cost structure, it becomes pretty risky.
Does the same hold true for defense? The reason I ask is, for example, shipbuilding. We were talking to Garden Reach shipbuilders.
Yeah.
But that management, so the book-to-bill ratio must be maybe 5x or 6x.
Sure.
But while their order book is 24,000 crores, I'm using that as an example, by the way.
Sure.
The management said that they expect that their order backlog or order book by the end of FY26 could be 40,000 crores from 25. And they believe that orders worth 1,80,000 crores would come in over the next 2-3 years, of which they will get mid-teens to high-teens kind of orders. So they expect order inflow.
Okay.
Their valuations have come off because all defense stocks have come down.
Yeah.
And their execution table looks solid. So does defense look similar like railways, or is that slightly different, you reckon?
No.
I'm asking this because a lot of people are invested in defense names.
No, it could be very different. See, again, I would go back to the stock picking. It should be bottoms up. In an rising tide, all the companies in any sector goes up. Number of companies in those sector also go up, right? Unfortunately, 10 years down, if you look at the 10-year, long-term perspective, there will be few winners. There is no question about it.
That's true.
Question is, are you in those? If you're invested in the entire basket, I'm pretty sure that basket is not going to
work.
Not going to deliver. Right?
But so, if the tide goes down, Samit, then will a good company also go down, or can a good company shine in a bad sector as well?
In the short run, it will also go down.
Okay.
In the short run, there is no like what happens in the upside, there is very little discrimination because it goes up because of the liquidity. In the short run, liquidity is what will take everything down.
Got it.
And that's where you get the opportunity to pick the right stocks. You look at examples of longer term companies, right? So for example, say APL Apollo. Steel cycle has gone nowhere. But in the last 10 years, look at their profit, profit delivery. Look at their, debt levels, what has happened. It's independent of the entire sector doing that well. Towards the end, then everyone gets funding and everyone starts doing well. But if you look at the next 10 years, 1 or 2 of those companies will be the winners.
Got it.
There won't be 10 players who would be the winners. So accordingly, I mean, you look at, in agrochemical companies like PI Industries, in consumer finance companies like Bajaj Finance or Chola, there will be only 1 or 2 winners. The rest will be below average, returns. And that's where you need to make sure whatever you are in are those winners. Think only from that longer term perspective, because most of the companies who went through upside where the promoters were taking advantage of frothy times, they went for multiple QIPs. They really don't have a real genuine long-term plan. They are making plans because now they are getting free money almost, and then they are deploying that money for expansion. But every expansion done at below ROE of what the investors return on investment requirement is destroying value, not growing value. Right. Any investment that goes which is above your return on investment, that's the only which adds market value, otherwise destroying market value. But during bad times, until that delivery really happens, there is a big gap of 2-3 years, because they're going through capex and people get excited and they think that it's going to add as much gross block, their market cap also is going to go up that much. And unfortunately it doesn't happen. It happens for only 1 or 2 companies. And it happens across many sectors. So there will be multiple winners in this. There will be multiple winners in defense. There will be, in the renewable energy. There will be across a lot of cyclical companies too. But only bottoms up will work.
My final question, Samit, and that is on the futuristic themes, because now we're starting to see them making their presence felt. New age companies or any few. By the way, I don't just mean tech players. I mean, anything which is futuristic in nature and coming up. But use that as an example that we now have, or we will now have one tech company or a consumer tech company being a part of the index. And a lot of people believe that what's happened in the West, wherein the consumer tech essentially became a large portion of the index as well, because the profit pools are growing. So from the futuristic themes, where is it that you are the most constructive? Here, you may have a view which is maybe 5-10 years out.
Yeah. So I'm not that good at picking these futuristic, themes, especially ones where they're not really making good profits, not making reasonable ROE, ROCs. As I said, I would like to pick companies which are high ROE already, where, my evaluation, whether they are sustainable, are they going to go through that, 20% kind of growth? And I need little more certainty. Then I'm pretty sure out of these packs of new age, there will be winners.
But that's not the pond that you're fishing in.
I don't have the ability to pick those right ones.
Okay, so then let me reverse the question, since I mentioned last question. So what would be the top 1 or 2 bets or top 2 or 3 bets in the portfolio? You may not choose to take names, but you could give an indication of what kind of businesses are there, what sectors do they belong in? Because I'm guessing now your portfolio is primed for the next 2-3 years, because you would have made changes, etc. So what are the top overweights?
Sure. So see, there are certain themes where I'm getting bullish again, just because of the valuation correction. There has been a huge time correction which these guys have gone through, and some of the themes which I like, one is secured finance, secured lending. So whether it's gold finance, and again there is one player who has significantly outperformed any other player in this, and where the gold prices have gone up by almost 40%, in rupee terms probably even more, so there is a huge sort of collateral that has developed where you still have the potential to grow. So secured lending, it could also be some of the home finance players which are going at 25%. You can see that their gross NPAs are still at 1%, and the valuations have halved. So there are really good opportunities in maybe the smaller ticket size, home finance companies where they have pretty good risk evaluation, processes, right? Other area is, which I've been always, bullish on, are things like fabrication pipes, where we do keep on changing the tactical allocation. It went through, at one point we had, say, allocation of 10% plus. when things slowed down, when the valuations went up, maybe we didn't think it was worth to completely exit it, but to reduce the allocation. So probably we took it to the lower end. But now if you see, there is a huge benefit to these players, mainly because of these patra players, or the scrap converters. The price difference between, say, HR coil, newly manufactured HR coil, and these converted from scrap is barely 1 or 2 rupees. Right? So there is a big market for these guys to capture from unorganized, because why would anyone want to buy? So a lot of these players may completely go out of business because they don't have too much of sustainable power. They could, if they can't really sell much and make profits, in a year or year and a half they go out of business and generally don't come back. So there is a big market for these guys to capture, even if at a total level there is not much growth. Again, I'm positive on the power finance, I'm positive on the luxury real estate, but these are again not sectoral bets that
these are all bottom up.
These are all completely bottoms up, and that's how the sectors sort of build up. You need to make, because the winners can come in from spaces which may not be at a sector level growing, but it could be that in a tough market sometimes the weaker players just go out of business, and then the strong players still can grow at 20% plus, right? So that's what you want. That it's very difficult to bring in, because sometimes when the sector becomes too profitable, there are a lot of players who want to come into it. So you may get really good sort of feel from a demand side, but then supply can suddenly come up, and it just they destroy the economics of the entire sector. That's what is more important. I think the demand supply gap is most important. Demand is easier to predict. Supply is very difficult to predict, because you don't know where and how quick the supply will come from. And if you have more confidence about that gap remaining, even if the sector is slow growth, but if someone is taking away more market share, I think it's better to bet on that. Market share again, I think, is one of the most resilient factor for sustaining ROE as well as resilient growth, because those players tend to grow during ups and down cycles. Whereas if you're just betting on sector play, you are completely riding the bull cycle of that sector. And if you get that bull cycle wrong,
then
if there is too much capex which goes on, it can destroy your returns. You may make money in the short run when things are just evolving, but when things stabilize, at that time you could go through big drawdowns.
Great. Samit Vartak, so good talking to you. Thank you so much for appearing on Talking Point Unfiltered. Really appreciate your time today.
Thank you so much, Neeraj.
Yeah. And viewers, thanks for tuning in.
Very, very warm welcome to you all for this NDTV Profit